What actually got Bangladeshi corporates to pay wasn't a firmer tone, the real story behind Bangladesh's simple crisis. Assalamu alaikum and welcome to Learning Bites, Mekan Ovi. What actually got Bangladeshi corporates to pay wasn't a firmer tone from regulators. It wasn't tougher speeches. It wasn't new circulars. And it definitely wasn't another warning from Bangladesh Bank. Because if tougher language solved banking crisis, Bangladesh would have fixed its bad loan problem years ago. So what really makes big borrowers repay? And more importantly, why did Bangladesh banking system become one of the most distressed in the world? Today we're diving into the hidden economics of loan repayment, political influence, and the uncomfortable truth behind Bangladesh's banking crisis. Part A: The myth of stricter regulations. When people discuss Bangladesh's non-performing loan crisis, the most common explanation is simple. Regulators weren't strict enough. Banks didn't enforce rules. Borrowers got away with defaulting. While all of that is true to some extent, it misses a deeper point. In every country, borrowers respond to incentives. A businessman doesn't pay back a loan because a central banker gives a stint speech. He pays because the cost of not paying exceeds the cost of paying. This distinction is crucial. For years, many large Bangladeshi borrowers operated under a belief that loan defaults carried limited consequences. Loans could often be rescheduled. Repayment deadlines could be extended. Political connections sometimes provided protection. And troubled borrowers frequently obtained fresh credit despite earlier payment issues. If a borrower believes that default leads to another restructuring package rather than asset seizure, the incentive to repay becomes much weaker. Part B: How the crisis was built. The NPL crisis didn't emerge overnight. It was built slowly over decades. Bangladesh enjoyed strong economic growth. Export earnings surged. The garment industry expanded. GDP growth often exceeded many of its regional peers. Yet underneath these impressive numbers, banking discipline was deteriorating. Banks increasingly concentrated lending among a small group of large corporate borrowers. Many loans were approved with weak due diligence. In some cases, political relationships became more important than credit quality. The result? A growing stock of loans that were technically performing on paper but struggling in reality. Visual: iceberg illustration, top official NPLs below water hidden stress, restructured loans, evergreening. Narrator: think of it like an iceberg. The reported defaults were only the visible portion. Beneath the surface sat rescheduled loans, restructured facilities, and exposures that survived largely because banks kept rolling them over. Part B: Why corporates finally started feeling pressure. Here's where many observers misunderstand what happened. What changed wasn't just the regulator's attitude. The economics changed. And economics always matters more than speeches. Beginning in the mid-2020s, several things occurred simultaneously. First, scrutiny increased. Second, international accounting and classification standards became harder to avoid. Third, political transitions altered long-standing relationships between borrowers and power centers. And finally, liquidity conditions tightened. Visual: 4 pillars. Greater scrutiny, stricter classification, political changeless liquidity. Narrator: when access to fresh financing becomes more difficult, repayment suddenly becomes much more important. Why? Because reputation starts mattering again. If banks aren't willing to provide endless refinancing, companies must improve their standing to secure future funding. Part C: The real engine of repayment. So what actually gets large corporations to repay loans? History gives us a clear answer. Not words. Consequences. Look at successful banking reforms across Asia, Europe, and Latin America. Borrowers began paying when they believed creditors could actually enforce contracts. That means Assets can be seized. Ownership can be diluted. Control can be lost. Future credit can disappear. And legal systems can act with credibility. These are the forces that change behavior. Visual, scale balancing. Left side, default. Right side, asset seizure, credit loss, legal enforcement, reputation damage. Narrator. When default becomes more expensive than repayment, repayment increases. This principle is universal. It applies in Bangladesh. It applies in Japan. It applies in the United States. And it applies everywhere capital exists. Part but, the political economy of banking. Banking crises are never purely financial. They're usually political. The biggest borrowers are often economically important. They employ thousands of workers. They contribute to exports. They maintain relationships with influential stakeholders. As a result, governments face a difficult balancing act. Push too hard and major businesses may collapse. Push too softly and moral hazard expense. Bangladesh spent years navigating this tension. The consequence was a system where many distressed borrowers remained alive through repeated restructuring rather than genuine recovery. This delayed recognition of losses. But it didn't eliminate them. Eventually reality catches up. And when it does, the adjustment becomes much larger. Part 2. Why bad loans matter to ordinary people. Many people hear the term non-performing loan and assume it's just a banking problem. It isn't. Bad loans affect everyone. When banks carry large losses, they lend less. Businesses struggle to obtain financing. Investment slows. Economic growth weakens. And taxpayers may eventually bear part of the burden through bank recapitalizations. In simple terms, every taka trapped in a bad loan is a taka that cannot support productive investment elsewhere. The lesson Bangladesh must learn. Conclusion: the lesson Bangladesh must learn. So let's return to our original question. What actually got Bangladeshi corporates to pay wasn't a firmer tone. It wasn't a new speech. It wasn't a tougher press conference. It was a change in incentives. A change in enforcement. A change in access to future credit. And a growing realization that losses could no longer remain hidden forever. The central lesson of Bangladesh simple crisis is surprisingly simple. Banking systems don't become healthy because regulators sound tougher. They become healthy when contracts are enforced, transparency improves, and both lenders and borrowers face real consequences for their decisions. The future of Bangladesh's banking sector depends not on stronger words, but on stronger institutions. Because ultimately, the most powerful force in finance isn't fear. It's credibility. Bangladesh simple crisis, reform or repeat? Comment below, can Bangladesh restore trust in its banking sector? If you found today's discussion helpful, please like this video. Share it with your friends and family. Subscribe to Learning Bites, make a movie. And press the notification bell so you never miss our next educational video on finance, economics, banking, taxation, and business. Thank you for watching. Assalamu alaikum.